Good afternoon again. Amalgamation, absorption, reconstruction, we have done about two problems. Problem number 1 we have done with the net purchase method and also the pooling of interest method. Then we have done problem number 4, which was quite big. Deva Limited, Devasura Limited, that particular problem we have done wherein net payment method we have done calculation of purchase consideration through net payment method, and then we have also done the problem with the journal entries in the vendor company. At the same time, journal entries in the purchasing company also we have done problems. Let us now take up a problem wherein we directly do the ledger accounts instead of journal entries in vendor company, and we will also draw an opening balance sheet. Let us take problem number 7. So problem number 7 I will first read out and explain you, then we will take up the problem. The board of directors of Lucky Limited decided to amalgamate the Unlucky Limited balance sheet on the two companies which are given below. He gave the balance sheet, the details which we can see while doing the problem. Then terms of sales are as follows. Lucky Limited takes over both assets and liabilities. So this part is important. If we are taking only assets, then that type of problem is different. When we are taking both assets and liabilities of the Unlucky Limited, that is the first condition. The second is the equity shareholders of Unlucky Limited are to receive one new share of 1 rupee each of Lucky Limited for every 10 shares held in Unlucky Limited. When that means in the Unlucky Limited, for example, we have 20,000 worth of share capital. The 20,000 consisting of 1 rupee each. That means number of shares will be 20,000 divided by 1. 20,000 shares are there. So 20,000 shares will, in place of this 20,000 shares, they will get only 2,000 shares. How? Every 1 rupee of Lucky Limited for every 10 shares held in the Unlucky Limited. That means for 10 shares, you will get only 1 share. So for 20,000 shares, we will get 2,000 shares. 2,000 multiplied by 1 rupee, 2 rupees should be payable to equity shareholders. Then preference shareholders will get one preference share of 1 rupee each in Lucky Limited for every 2 shares held. That means if you have 2 shares, you will get 1 share. Here we have 10,000 worth of 5% preference shares in Unlucky Limited. 10,000 consisting of 1 rupee each. So 10,000 divided by 1 is 10,000 shares. So 10,000 multiplied by 1 by 2, that comes to 5,000. So 5,000 plus 2,000, 7,000 is the purchase consideration. Then we need to, he also gave that amount of 5,000 is paid towards the cost of liquidation, which is met by Lucky Limited. Land and buildings of Lucky Limited are valued at 40,000 and a provision of 1,000 is to be made for doubtful debts in case of Unlucky Limited. What does it mean? It means that the takeover of the company is done while doing land and buildings are to be valued at 40,000. That means he gave in the balance sheet land and buildings value is given only 15,000. That 15,000 rupees worth of land and buildings has to be taken at the rate of 40,000 for the purchasing company. And we need to deduct 1,000 towards the doubtful debts also. Taking these amendments into account, we need to draw the balance sheet. And we also should show necessary ledger accounts in the books of Unlucky Limited. So let us take up first the ledger accounts in the Unlucky Limited. Before that, we will write the calculation of purchase consideration first. Yeah, we always need to follow the format. So calculation of purchase consideration, we need to take item number 2 given in the adjustments, problem number 7 of Jain and Narang we are doing. Equity shareholders of Unlucky Limited are to receive one new share of 1 rupee each in Lucky Limited for every 10 shares. There are 20,000 shares in Unlucky Limited, and they will get 10 shares, one share for every 10 shares. One share for every 10 shares. So 20,000 multiplied by 1 by 10, which comes to 2,000 shares of rupees 1 each. So you need to multiply 2000 multiplied by 1 comes to 2000. Similarly, preference shareholders, there are 10,000 shares, 10,000 preference shares. In Unlucky Limited, will get 10,000 multiplied by 1 by 2, because for every 1 share they are giving 2 shares. So 5,000 shares we will get at the rate of rupee 1 each. That comes to 5,000. So total purchase consideration is 7,000. Now we need to start the ledger accounts in the vendor company. The vendor company here is Unlucky Limited. In the books of Unlucky Limited, we will start with the realization accounts. We follow all the procedure that need to be followed whenever you open the ledger accounts. You need to have particulars column, rupees column, debit, credit, everything should be shown. Normally students do not care to write these things, which will cost them more in terms of marks. So the first job to be done in realization accounts is to transfer the assets of the Unlucky Limited or the selling company assets at a book value. So when you take the assets, we have land and buildings, tangible assets. Land and buildings, we are transferring 15,000 worth of asset given in the textbook balance sheet. Then we do not have plant. Intangible assets, goodwill is there. Goodwill also can be transferred, and thereby you can have goodwill we can directly take, since goodwill is not normally taken over by the purchasing company, we can skip that. So stock given in the trial balance, given in the textbook, is 5,000. Then debtors, book value I am transferring. Book value is 10,000. There is no cash in hand in this. And when it comes to, while transferring, as far as the vendor company is concerned, though as I mentioned yesterday in another problem, some people do not transfer the goodwill, but we advise that you transfer all assets at book value, as we have done discount on shares in another problem yesterday. So this comes the total 40,000. Now first entry is over. We have transferred the assets. Now we need to transfer the liabilities. The liabilities credit side, if you look, creditors is there. By creditors 10,000. By overdraft another 10,000. That's all. Reserves and surplus, etc. we don't transfer here. We don't transfer the reserves and surplus. Coming to the next is the third entry, as we have done yesterday. The third entry is about the purchase consideration. The purchase consideration agreed is 7,000, and this 7,000 is to be received from the purchasing company. So we need to debit we are selling our business to purchaser. So purchasing company should be debited. Debit the receiver. The receiver here is Lucky Limited. So by Lucky Limited should be debited, and credit should be given to realization. You are having that amount 7,000. Now if you look down, we have we keep it pending here. The reason is we need to look whether we are likely to incur any more losses. Though he gave 5,000 towards the expenses, that expenses will be borne by the purchasing company, not the selling company. Hence we don't have to show here. So let us now show the equity shareholders account and preference shareholders account. You need to pay them separately. So equity shareholders account, debit, credit, and when we have this, a small one is enough. Particulars, rupees, particulars again, rupees. Now share capital is having a credit balance in the balance sheet. We will have to transfer that share capital to the shareholders account. You debit the share capital, then share capital account gets closed. Debit the share capital and credit the shareholders account by share capital. By share capital you have 20,000, entire 20,000 is transferred by the shareholders. Then 5% preference shares are there, that we need to open preference shareholders separately. 5% preference shareholders account. Here also you have debit, you have credit, then you have an account down which comes to rupees again, inner column, particulars. All these things we should not skip, because the success lies for the accountant always in presentation. How do you present is very important. If you present it badly, that is not correct. By share capital, preference share capital, we are same entry, preference share capital he gave in the balance sheet 10,000. So by preference share capital 10,000, I am putting it here. So we transferred both the share capitals. Reserves and surplus is there. All reserves and surplus will go to only equity shareholders. But in this problem, if you look, there is no capital reserve, there is no general reserve in selling company. There is only surplus account. That also he gave negative balance minus 10,000. That means it is a loss, accumulated loss. That should be borne by equity shareholders. So you transfer to the equity shareholders to surplus in bracket negative. In fact, it is a loss. So 10,000 I am debiting it to the shareholders. So you need to pay only 10,000 to them as per the accounts that we have. Then looking to the next is, you have both preference shareholders and equity shareholders you have transferred. So all accounts now we have transferred them to one account or the other. So all the three we have transferred. There is no need for bank account because we are not paying any cash now, and we are not dealing with the cash. So three accounts are sufficient. Now we need to work out as per the adjustments. The first one, Lucky Limited will be taking over both assets and liabilities. We have transferred assets and liabilities to the realization. Second one, purchase consideration, we wrote the entry. That is, equity shareholders are to receive one new equity share of one Lucky Limited for every 10 shares, and preference shareholders 5% preference shares for every 2 shares held in that. So they are getting out of 10,000, they will get now you will be getting the shares from the purchasing company. For that you need to write shares, equity shares in purchasing company, that are 2,000. Preference shares in purchasing company 5,000. To Lucky Limited 7,000. That means if you draw the Lucky Limited account, you don't have to draw because these three are important. But if you feel that you get confused, you can draw and show for your purpose. Lucky Limited, this is purchasing company. Debtor, creditor, rupees, particulars. Then you will have more clarity on this because we are not writing journal entries. To realization, you show 7,000 here. This is 7,000 credit here, debit here. So that's over, first entry. Then we are getting the shares from them. For that, debit the shares, equity shares in Lucky Limited 2,000. By preference shares in Lucky Limited 5,000. So this gets closed, 7,000. What will you do with these shares? The shares have to be transferred to shareholders. So equity shares will go to equity shareholders, to Lucky Limited, then this is 2,000, and to Lucky Limited here 5,000. This completes this account. Now if you carefully observe, preference shareholders are getting only 10,000. The loss on realization they need not bear, but we are paying only 5,000 for paying 10,000. That means the firm is getting benefited, the preference share capital shareholders, this company is getting a benefit of 5,000 by discharging lesser amount to the shareholders. Though we have to pay 10,000 to them, we are paying only 5,000. So we gained some amount, and this gain will go to the realization account. So this gain, if you transfer to the realization account, so realization account debtor to preference shareholders accounts 5,000. Right? So you can transfer it to the realization accounts. Sorry, preference shareholders we have debited, right? Sorry, preference shareholders account at our to realization 5,000, and this is a gain, and this gain will be credited to the realization account by preference shareholders 5,000. This account gets closed. This account gets closed. There are only two accounts now, both are to be mutually transferred. We should always close equity shareholders last. So we need to find out whether you are getting any profit or loss. So if you look here, you are getting 40,000 as total debit side more, and this side if you look into it, it is 32,000 you are getting. The difference 8,000 is the loss on realization. This should be borne by equity shareholders account. So you will transfer this to the equity shareholders. Equity shareholders account that are to realization 8,000. So this account also gets closed. This also gets closed. So you will find that not a single account remains with any balance. Then it's called closure of the accounts. We have closed. We have done yesterday a problem where we have written journal entries, and now we are doing a problem with ledger accounts. This completes the vendor company. He asked the second part also, prepare a balance sheet of Lucky Limited. This is a very simple problem, therefore I will straight away go to the balance sheet, because we have already calculated the purchase consideration. So balance sheet we have been showing vertical form only. So Lucky Limited in the books of Lucky Limited, balance sheet as on 31st March 2017. Now, the first item will always be capital and liability. Under this, we show first Number one, share capital. Under the share capital, we must check what is already existing in the equity shareholders. As per the share capital, he gave us equity shares of 1 rupee each, 63,000. So 63,000 is already existing, and another 2,000 you have issued to the shareholders here. There is no premium, no discount. Simply you have to just add and then show it. So that comes to share capital 63,000 plus 2,000 issued to shareholders of Unlucky Limited, together is 65,000. Then second item is preference share capital. When it comes to preference share capital, you are not issuing any preference shares, are you? Yes. And the preference shareholders, 5% preference shares of 1 rupee each in Lucky Limited for every 2 shares. You are issuing preference shares also. So preference share capital. Again, if you look to what is existing in the balance sheet, you will find that nothing, nil. There is no preference share capital in the Lucky Limited. But in Unlucky Limited, we have issued 5,000 worth of preference shares. We have done here. So that 5,000 will appear here as a preference share capital. This completes the capital. The second part is the reserves and surplus. Under the reserves and surplus, we must find out what are given. You are given capital reserve 30,000, general reserve 30,000. So if we look to this, we need to adjust the profit or loss in acquiring the assets of the Unlucky Limited with the whatever we have existing in the reserves. So that part is the important part which we need to do in the working notes if necessary. So reserves, if you look, capital reserve 30,000, general reserve 30,000. But we should know how much we are gaining or how much we are losing. This can be done by looking to the value of assets we are acquiring from the company. Because we are not writing the journal entries, we should calculate here. Value of assets taken over. So if you take this, we need to write number one, land and buildings. Though the value given in the balance sheet is only 20,000, 15,000, it is given that we should treat it as equivalent to 40,000. He gave you that land and buildings are valued at 40,000. So value of assets is 40,000 here. Then comes the plant and machinery is not there in the Unlucky Limited. Goodwill 10,000 is there, we don't take that goodwill here. Closing stock, there is no change, same 5,000 we are taking over the assets. And then plant and machinery is not there, stock is over debtors. When it comes to debtors, he gave that 5% provision must be made on 10,000. When you calculate 5%, it comes to 1,000. 10,000 into 5 by 100 is equal to 1,000 rupees. 1,000 rupees when you subtract, it will be 9,000. So total value of assets we are taking is 54,000. We have also agreed to discharge the liabilities. The liabilities agreed are creditors given to us is 10,000, and you have less overdraft 10,000. then we are also, when we subtract these two, it will be 34,000. Then again, less we have agreed to pay closure expenses or winding up of expenses of the purchasing company. So winding up expenses will be another 5,000. So when you deduct these three, 25,000 from that, you will get 9,000. 54, 14 minus 5 is 9, 4 minus 2 is 29. 29,000. Now 29,000 is the benefit you are getting, whereas this is the benefit we are getting by acquiring the unlucky limited. So we can say value of assets in simple terms. Whereas you are paying purchase consideration 7,000 only. So net benefit you are getting 22,000. This net benefit that you are getting 22,000, since it is a benefit, we transfer it to capital reserve. That means our capital reserve must be added to the extent of 22,000. So 22,000 is the capital reserve. So we need to show in the balance sheet the capital reserve that is already existing in the Lucky Limited is 30,000. We need to take, add capital reserve from Unlucky Limited, $22,000, total 52,000. We put it in the outer one. Then comes general reserve. There is only general reserve in Lucky Limited. You show that 30,000 outer column straight away. Then comes non-current liabilities. Third one is non-current liabilities. Under the non-current liabilities, you need to show there is no non-current liabilities in both the places. Yeah. So dash. Then the fourth one is current liabilities. Under the current liabilities, you show creditors, you have 2,000 plus 10,000. 2,000 is Lucky Limited, 12,000 is Unlucky Limited, total is 12,000. Then that's it. Overdraft. Overdraft, you have only one, that is 10,000. Unlucky Limited. This completes the liabilities. So when you add them, you get total liabilities. $174,000, 1,74,000 is the balance sheet we got. Is it so? Okay, now let us go to the assets. When you go to the assets, first we show non-current assets. Under the non-current assets, you can show tangible assets. Tangible assets, you find number one, land and buildings. Land and buildings, here you have 25,000 plus 40,000 from Unlucky Limited. Together is 65,000. Then you have plant. You have plant only in the Lucky Limited, 35,000. Then intangible assets. You will take only the goodwill of Lucky Limited. That's appearing as 10,000. Then you have copyrights. This also you have only Lucky Limited, 5,000. Then you have closing stock, that is non-current assets. Under the current assets, you show closing stock. Both the companies are there. Closing stock, you have Lucky Limited, given in the problem is 10,000. And Unlucky Limited is 5,000. Outer column 15,000. Then you find cash in hand, debtors. Debtors again, Lucky Limited is 10,000 and Unlucky Limited is 9,000 because we have deducted 1,000 there, so 19,000. Then the last item, cash in hand. Yeah, here you need to remember that cash in hand is 30,000. From this we will need to pay the liquidation expenses of the company, 5,000. I don't think that we have any other adjustment. If you don't have any other adjustment, 25,000 should be shown as asset in the balance sheet. There is no cash in hand in the other company. Now let us total this. This comes to 1, 2, 3, 4, 5. 5 5s are 25 plus 9, 34. 34, 3 carrying, 5, 6, 7, 8 plus 3, 11 plus 6, 17, 1,74,000. I'll write it clearly here. 1,74,000. Yeah, you can total them. You will get same 1,74,000. I am writing it here. This is the balance sheet you prepare and total it. This completes the problem. Let me sum up what I have done. First, we have calculated the purchase consideration. We have paid for every 10 shares held in the Unlucky Limited, we paid 1 share. Therefore, for 10 shares it is 1. So for 20,000 shares it will be 2,000. 2,000 shares at the 1 rupee each, 2,000. Then 10,000 preference shares in Unlucky Limited. For every 1 share we are giving 2 shares, we are giving 1. So 10,000 into 1 by 2, 5,000. Total 7,000 is the purchase consideration. We have transferred all assets, all liabilities. We have opened the shareholders account. We have opened preference shareholders account and then purchasing company account. Purchasing company, and we have tallied mutually all the accounts are closed, and this completed vendor company. When it comes to the balance sheet of the purchasing company, we have merged both and then shown them and the reserves also, whatever the loss or profit that we are getting it from the amalgamation or merger should be adjusted with the reserves that are existing in the purchasing company. So we have deducted 22,000, we have added 22,000, which is a profit from the Unlucky Limited, that is our capital reserve, comes to 52,000. And general reserve, whatever is given. Current liabilities we have shown as it is. Assets listed out one by one, merging both the assets and then shown at agreed values, not the book values. That is the difference. With that, balance sheet gets done. So this is how you need to do the amalgamation, absorption, reconstruction problems.